Hello, my name is Charlie Moran. I'm a senior analyst here at ValueLine. I'm joined today by two other senior analysts, Alan House and Nate Aikman. Today we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, ValueLine.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including all the equities under our coverage. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at ValueLine.com, or you can call 1-800-ValueLine. Now let's discuss the economy and the stock market. This content was prepared by ValueLine's economic staff. The Federal Reserve remains on its higher for longer interest rate course. The Fed Open Market Committee, FOMC, kept the federal funds target rate steady at 5.25% to 5.5% during its June meeting, but also took a slightly more hawkish stance on monetary policy. Specifically, the central bank reduced its outlook for interest rate cuts in 2024 to just one, down from its March projection of 3 reductions. Fed's statement also showed that 4 senior voting members now see no interest rate cuts this year. Meanwhile, Wall Street has taken a more dovish position on near-term monetary policy. Such sentiment gained steam after the Labor Department reported weaker than expected May readings on consumer and producer prices, which may be an indication that inflation is easing. The Street now anticipates 2 rate reductions by year's end, with the odds of a cut as early as the September FOMC meeting building. This consensus view was the primary reason why Treasury yields did not spike on the Fed's June monetary policy prognostications and Chairman Powell's remarks. The health of the U.S. economy will likely determine the Fed's monetary policy course during the second half of the year. To date, the economic data, which include a still resilient labor market, have put minimal pressure on the central bank to reverse course short of achieving its goal of bringing price growth closer to its 2% target rate. With the possibility of a soft landing still in play and absent certain parts of the economy coming under significant duress, particularly the consumer sector, the lead bank is likely to keep rates sufficiently restrictive in the near term. Accordingly, investors took the recent soft retail sales statistics in stride. The next big event for Wall Street is second quarter earnings season. There, analysts' expectations for S&P 500 companies have risen, with the estimated growth rate for the index now just shy of 10%. This would mark the biggest advance in more than 2 years and may be needed to justify the elevated price-to-earnings multiple for the S&P 500 index. In conclusion, with equity market valuations quite frothy and the Fed still not ready to pivot on the monetary policy front, we think investors should target the stocks of high-quality companies with a track record of producing steady earnings and cash flow growth. Please refer to the inside back cover of Selection Opinion for our statistically based asset allocation model's current model. On that note, ValueLine is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, ValueLine provides a great deal of daily content that can help you avoid the pitfalls and profit during the volatile time in the stock market. Every business day, senior members of ValueLine's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and its shareholders. This content is posted throughout the day on our website. Again, that's ValueLine.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, ValueLine has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength along with price stability, another proprietary ValueLine measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, ValueLine provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move into the one stock to buy right now. For this, let's go to the screener. ValueLine subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-ValueLine. So as we go to the screener, the current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and the possibility of a recession. Many large, well-known stocks have grabbed headlines lately, but we would like to search for other equities with better long-term potential with average risk profiles. We'll start with the screening process by looking at safety and safety and timeliness ranks in the ratings and ranks section. And the first filter that we are going to look at is a safety rank of 2 or better. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. And by applying the first criteria, we've trimmed away our potential candidates down from 5,700 to, I believe, 400, approximately 401. The second filter we will be using is a timeliness rank of 2 or better. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the entire ValueLine universe. The format is the same as described above with regard to the safety rank, and by applying that filter, the number of matches is narrowed down to 67. And then our final third filter will be one that is a price-related filter, and it's a rise. We're going to use 60% from the 52-week low of the stock price. And by applying this filter, one can move the bar, as you can see, or you can just enter it into the space there that you so choose. And by entering that constraint, the number of matches goes down to 7. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Novo Nordisk. Before I click on Novo, please note that screens can be saved and revisited by utilizing the created saved screen button at the top. So now let's go to the Novo Nordisk digital report, if at all possible. Well, there you are, saving the save screen button tab. In any event, as we bring it up here, the Novo Nordisk's growth has accelerated in recent quarters. The company has benefited from drugs related to obesity and diabetes care, and in fact, it is well known for its franchise of diabetes care drugs. GLP-1 drugs should play a big role in continued success, considering that they will launch next-generation obesity drugs prior to patent expiration of current bestsellers. We think this will help sustain growth, though competition is rising. Otherwise, the company's financials are in solid shape. It has our highest financial strength ranking. Moreover, though the valuation appears rich, we are also encouraged that certain GLP-1 drugs may have applications in other areas such as cardiovascular and osteoarthritis segments. And I should also note that after we had compiled this report, I believe earlier this week, there was some mention of them entering or having license to enter into China with some of these drugs, which caused the stock price to push up even further. But all told, we think that Novo Nordisk is poised for strong results in coming quarters, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation, and now I will hand it off to Nate and Alan. Thank you.
All right. Thanks, Charlie. Okay. I'm seeing a question. What is the best AI stock currently? Now, I can't address specific stocks on this call. However, I can talk a bit about methodology and how to evaluate AI companies as investments. Um, my view is that when it comes to investing in AI specifically, the only worthwhile investments in that space are going to be companies that are doing cutting edge research and development on developing AI technology itself. And there are two reasons for this. The first is that in terms of implementation of AI into, company workflows, which is, the area that a lot of companies are sort of touting their AI involvement now. The truth is that while AI as a buzzword has gotten a lot of traction since ChatGPT came out in November of 2022, in actual AI integration into, company products and work has been going on for much longer than that, just more quietly. So while you're hearing a lot more about it now, you're not necessarily actually going to see these huge process improvements from companies that are saying, oh yeah, we're adopting AI now. Because the truth is, AI will have been integrated into many aspects of their operations for, a number of years at this point. Um, the other reason is that looking forward in terms of where the technology goes in the future, there are really only two options. Option one is that it runs into technical hurdles over the next couple years, like insufficient data for future development. This is called the data drought scenario. And in that scenario, we have this big blow up with AI right now, and then it doesn't quite get off the ground in a huge way. Things settle down. It continues to be quietly useful in the background, but that's sort of where it stalls out for at least a couple of years. The other scenario is that those sorts of problems that could lead to the data drought scenario get solved, and in this scenario, we see a much sharper ramp in terms of AI capability in the next couple of years. Um, but in that case, a lot of things that companies are, doing with AI right now, saying, oh, yes, we're getting this into our operations, we're doing this, are not actually going to matter very much. Like, if the technology takes off in a way it does in the way we're thinking it might in scenario two, then having integrated an OpenAI chatbot is not going to make a huge difference to how that affects your company in 5 years. Like, being like, yeah, okay, you put an OpenAI plugin in your product, whatever. So did everyone else. That's not impressive. Um, and so looking at it that way, the only real worthwhile investments in AI specifically are going to be, cutting edge R&D, which is a much smaller slice than all of the companies who are trying to position themselves as AI related right now. And so that's going to be both software and hardware R&D. That is where you want to look if you want some sort of exposure to AI, because that is the only place where that investment is going to be meaningful over the next few years.
That was very informative. I see a question. Someone is new joining us. I just want to welcome them and anyone else that might be new to our webinar. They asked how often this webinar is, and we have a webinar on a monthly basis. Um, Most of the time, just one stock to buy right now. We do have a dividend income and growth product. We do a webinar on that once or twice a year. We also have an options product. We occasionally do a webinar on that, but we do a webinar every month, with most of the webinars being the one stock to buy right now, which is what we're doing today. So I just want to put that out there for all of you that may be joining us for the first time. Thanks.
Mhm.
I also see another question. Someone asked, what sectors do you think will outperform over the next decade? And that's an excellent question. ValueLine looks at stocks and companies on three different parameters. They don't look a decade out. That's a bit, too far for our crystal ball per se, but we do look, our time-tested, timeless ranking system looks at stocks based on the next 6 to 12 months ahead. And then we have a 3 to 5 year outlook on all of our stocks. And fairly recently, probably 5 or 6 years ago, we instituted the 18-month target price range, which is for people with an intermediate term investment horizon. So, all our stocks have all of those projections, so to speak. So if you're interested in a particular stock or sectors, it's probably best to peruse that segment to see which stock is best fits your investment needs. Thanks.
Mhm.